What if I told you the internet almost died before it even had a chance to begin? This is the story of how the dot-com bubble wiped out $5 trillion in market value, crushed thousands of promising startups, and accidentally paved the way for Amazon, Google, Facebook, and literally everything you use on the internet today. It's a story of spectacular delusion, catastrophic failure, and unexpected rebirth that changed the world forever. Once upon a time, in the ancient mystical land of 1995, a terrifying noise echoed through living rooms across America. The sound of dial-up internet connecting, slowly, painfully, magically. That screeching digital scream that sounded like a robot having an existential crisis. And everyone who heard it agreed on one thing. This internet thing was going to change the world. Parents would walk past their teenager's bedroom door and ask if the phone line was broken or if their kid was summoning demons. The teenager would respond that they were just downloading a picture of a cat wearing sunglasses, and it would only take 11 more minutes to complete. The internet didn't make any logical sense to most people, but it didn't have to make sense. It blinked mysteriously. It buzzed constantly. It screamed at you like a haunted fax machine possessed by the ghost of future technology. Nobody really understood what it was or how it worked, but everyone agreed it represented the future. The future, trademark pending, mysterious, glitchy, glowing with possibility, and absolutely full of unlimited potential. Early internet pioneers like AOL, Yahoo, and Netscape blazed the trail into this digital wilderness. The internet was like the Wild West, but with fewer cowboys on horses and more nerds wearing socks with sandals typing frantically on keyboards. You had to wait 5 minutes just to load a single picture of a dancing baby, but nobody cared about the inconvenience. The mere act of being online made you feel like a technological prophet who could see the future, even if you had absolutely no idea what JavaScript was or how computers actually worked. You were convinced you were participating in writing the next industrial revolution. And then Wall Street discovered the internet, and everything went completely insane. Upon hearing the magical words online bookstore or internet startup, venture capitalists reacted like a dog hearing someone open a bag of chips in the next room. Investors drunk on optimism and decaf lattes started pouring billions of dollars into literally anything ending in .com. The pitch meetings became absurd parodies of rational business discussion. What does your company actually do? Well, it's called toiletseater.com. It uses artificial intelligence to predict when public restrooms will be vacant. That's brilliant. Give them $200 million immediately. Suddenly, every startup with a half-baked idea was treated like a golden ticket to financial Valhalla. All you needed was a terrible idea that made no economic sense, a logo designed in Microsoft Paint by someone's cousin, and a founder who could say the magic words internet, first mover advantage, or disruptive at least 3 times during their pitch presentation. Congratulations, you now had a $100 million valuation despite having 0 revenue, 0 customers, and 0 viable business model. Let's examine some spectacular examples. Pets.com became famous for its sock puppet mascot and its remarkable ability to burn through $300 million in investor money while selling 50-pound bags of dog food at a loss on every single transaction. When investors discovered this unsustainable business model, they responded by giving the company even more money. eToys burned through cash like a Bond villain hosting an endless barbecue. Webvan promised to deliver groceries with the speed and accuracy of a military strike operation and then collapsed spectacularly like an overcooked soufflé. But nobody in the investment world even blinked at these warning signs. The Nasdaq stock index quadrupled in value. Initial public offerings became the new celebrity weddings that everyone wanted to attend. The media couldn't get enough of the internet gold rush. Financial talk shows started sounding less like business analysis and more like tech gospel preached from Silicon Valley pulpits. A typical segment would sound like, "Welcome back to Money Madness." Today's hot investment tip is a website that mails you customized socks for dogs. It's going to revolutionize the entire paradigm of pet fashion. By 1999, the hype had reached absolutely final, boss-level intensity. Super Bowl advertisements featured companies that nobody had ever heard of before. Some of these companies had no actual product to sell. One commercial simply said, Our website launches in March. Please clap. And the crowd actually did applaud, enthusiastically. People weren't investing in legitimate businesses anymore. They were investing in vibes, feelings, and promises of future disruption. Stock prices soared to absurd levels, completely disconnected from any financial reality. Everyone was suddenly rich on paper, even though nothing of real value had been created. Teenagers were day trading from their bedrooms, making and losing fortunes. Your aunt with the crystal collection was buying tech stocks based on horoscopes. Even your dentist probably had a side hustle coding JavaScript between patient cleanings, trying desperately to get listed on the Nasdaq. Between 1998 and 2000, over 12,000 new .com companies were born into this insane environment. Some had ping-pong tables, massage chairs, nap pods, cereal bars, and electric scooters scattered around their offices. If your office looked like a daycare facility for billionaires in training, investors assumed you were the next Microsoft. No one asked uncomfortable questions about profits or sustainable business models. Revenue was treated like a quaint myth from the old economy. Burn rate, the speed at which you consumed investor cash, was somehow considered glorious. It wasn't about making money in the present, it was about scaling rapidly. Scaling to what exactly? No one really knew the answer. But that uncertainty didn't stop anyone from continuing to pour money into the fire. And through all this madness, one sentence echoed constantly in every boardroom and newsroom across America. This time, it's different. Well, actually, it wasn't different at all. But no one wanted to hear that inconvenient truth, because this wasn't just a gold rush. It was a mass delusion, wrapped carefully in layers of technological optimism. Everyone genuinely believed the internet would change everything about human civilization, and it eventually would, just absolutely not like this. Not through companies that sold dog food at a loss or promised to revolutionize sock delivery. Somewhere deep in garages across California, a few quiet nerds named Bezos, Brin, Page, and Musk watched it all burn bright, knowing instinctively that the real internet revolution hadn't actually arrived yet. The hype train was speeding at maximum velocity straight toward a cliff, but these visionaries were already building the tracks for what would come after the inevitable crash. In March 10th, 2000. The Nasdaq hit an all-time high at 5,048 points. Champagne flowed freely in celebration. Office chairs rolled across expensive floors. Spontaneous celebrations broke out across Silicon Valley like it was the dawn of a glorious new era. And in a strange way, it actually was a new era, just not the one anyone expected. The internet felt completely unstoppable. This wasn't a bubble, investors insisted. This was the future, unfolding in real time, before everyone's eyes. And then, almost imperceptibly at first, things began to break. A few .com companies started missing their earnings targets and revenue projections. Questions that were once considered optional or even rude suddenly came roaring back into fashion. Wait, what's your actual revenue? How many real customers do you have who pay money? Are you actually profitable or just burning through investment capital? Webvan, after spending over $1 billion building a hyper-optimized grocery delivery empire, reported devastating losses with no path to profitability. Pets.com, once a marketing darling with national recognition, admitted it was hemorrhaging cash with absolutely no end in sight. The mood shifted dramatically. Confidence turned to confusion. Confusion turned to creeping doubt. The markets, once euphoric and unstoppable, began to slide slowly at first, then faster. Then came the massive sell-off as panic spread. The Nasdaq, once a powerful symbol of technology's unstoppable rise, plunged 78% over the next 2 years, dropping from 5,048 to just 1,114. It wasn't a temporary dip or market correction. It was a complete collapse of everything the .com era represented. Over $1.7 trillion in market value simply disappeared into thin air. More than half of all .com companies shut down permanently. Some were sold off for scraps to competitors. Others simply vanished without a trace, as if they had never existed. But it wasn't just companies that evaporated in this collapse. It was an entire belief system about how the internet economy would function. Amazon lost 95% of its market value and was widely predicted to go bankrupt. Yahoo's stock plummeted from hero to zero. eBay barely survived, kept barely afloat by niche buyers obsessively trading Beanie Babies and leftover electronics. For a brief, surreal moment, the most financially stable website in all of Silicon Valley appeared to be Neopets, the virtual pet game. The fallout reached far beyond Wall Street trading floors. Offices emptied as layoffs swept through the industry. Stock options that had made people feel wealthy became completely worthless overnight. Engineers packed up their desks and personal belongings. Foosball tables that symbolized the glory days landed unceremoniously in dumpsters. The same CEOs who had once been featured on glossy magazine covers as visionary geniuses now rebranded themselves as cautionary tales, giving somber TED Talks with titles like How to Survive Losing Everything You Ever Built. The media, which had spent years hailing the dot-com revolution as the second coming of human progress, quickly changed its tune completely. They called it the dot bomb and treated every failed startup as entertainment. Venture capital funding dried up overnight as if someone had turned off a faucet. Startups looking for funding were ghosted by investors who wouldn't return their calls. Boardrooms that once looked like futuristic playgrounds were suddenly quiet, reflective, and tense with fear. The narrative had flipped entirely. The internet wasn't the new electricity that would power civilization. It was the new tulip mania, a historical fad, a costly and embarrassing detour in humanity's pursuit of genuine innovation. Anything with .com in the company name became radioactive and toxic. Some surviving companies rebranded just to escape the stigma. College students switched majors away from computer science. Enrollment in computer science programs dropped over 30% by 2005 because why would anyone learn to code if all it gets you is a layoff notice and worthless stock options? The dream that had consumed an entire generation was over, at least that's what it seemed like at the time. But even as the ashes settled and the apocalyptic headlines faded, something unexpected began to take shape beneath the rubble. Something quieter, more resilient, and ultimately much more real and sustainable. While most .com startups collapsed faster than anyone could have imagined, a handful of companies didn't fail. They didn't panic. They didn't engage in desperate posturing or pivots. They just kept going quietly, methodically, like disciplined engineers who'd somehow missed the memo that the party was over and everyone was supposed to give up. Let's talk about Amazon. In 2001, Wall Street had marked the company for certain death. The stock fell catastrophically from $17 to $6 per share. Headlines gleefully called it Amazon.bomb and predicted imminent bankruptcy. Investors ran for the exits in panic, and truthfully, the situation looked absolutely grim from every angle. But Jeff Bezos didn't flinch or change strategy. His message was simple. We deliver books to customers, not dreams, not vibes, not revolutionary promises, just actual books that people order. He systematically shut down unprofitable ventures and experimental projects, cut costs ruthlessly, refocused the entire business around a single powerful idea. Get products to customers faster, cheaper, and better than anyone else. No gimmicks, no distractions, just relentless operational execution. If a customer in rural Nebraska wanted a specific paperback delivered by Thursday, Amazon made it happen. Not through inspiring vision statements or glossy presentations, but through superior logistics, warehousing, and fulfillment. Meanwhile, Google was still just a couple of Stanford graduate students working in a cramped garage. No expensive commercials, no flashy IPO, just brilliant code and elegant algorithms. Their mission was deceptively simple. Make search results more useful and relevant for users. While other companies desperately chased headlines and media attention, Larry Page and Sergey Brin were quietly refining algorithms that would eventually redefine how the entire internet functioned. They also had a modest side experiment called AdWords that nobody paid much attention to at the time. It would later become the foundation of modern digital advertising worth hundreds of billions of dollars, but back then, it was just a clever way to keep the lights on and fund their research. Then there was eBay, surviving against all odds. While other companies burned massive amounts of cash chasing impossible scale, eBay kept doing one thing exceptionally well: connecting buyers and sellers directly, from collectible coins to used fax machines. The platform was strange, simple, and most importantly, actually sustainable as a business. So what fundamental characteristics separated the survivors from the casualties in this massive extinction event? One word: profitability. The survivors had real customers who paid money. They had actual revenue. They had a working business model that made economic sense. They weren't pitching vague dreams about reinventing human communication or disrupting entire industries. They were solving genuine real-world problems that people cared enough about to pay for solutions. They grew only after they proved market demand existed. They hired employees only after they had reliable cash flow. It wasn't flashy or exciting, but it actually worked as a business. While the hype machines collapsed spectacularly, the survivors leaned into fundamentals: smaller operations, scrappier teams, but built to last through economic uncertainty. And then there was the hidden legacy of the dot-com crash that nobody talked about: infrastructure. Billions of dollars had been poured into servers, fiber optic cables, data centers, and developer talent during the boom years. And when the companies disappeared, all of those physical and human resources remained behind. Like the Roman roads that outlived the empire that built them, the internet's skeleton infrastructure stayed in place, waiting for the next generation. By 2003, the fog of panic and despair began to slowly clear. The next generation of entrepreneurs wasn't pitching grand revolutions that would change everything overnight. They were building practical platforms that solved specific problems. Facebook started in a Harvard dorm room. YouTube emerged from a modest garage. Twitter began as a side project with uncertain origins and unexpected massive impact. These new companies didn't throw extravagant launch parties with celebrities. They didn't need them. They built quietly and efficiently on top of the infrastructure their failed predecessors had left behind. And then in 2007, Steve Jobs stepped onto a stage in San Francisco, held up a small glass rectangle, and the world changed forever. The iPhone wasn't just another device or gadget. It was a gateway to a completely new way of living. The internet stopped being something you accessed at specific times, from specific locations, and became something you lived inside constantly. Perpetual connectivity, portable computing, deeply personal technology. The rebirth of the internet was complete. Google wasn't just a website anymore. It had become a verb integrated into language. Amazon wasn't a risky gamble. It had become convenience itself redefined for modern life. The internet wasn't a bubble anymore. It had become the fundamental backbone of modern civilization. The companies that survived the crash became titans worth trillions. The ones that didn't survive became cautionary tales shared on LinkedIn and business school case studies. Yes, the internet was almost killed in 2000. Overhyped beyond reason, misunderstood by investors, brought to the absolute edge of collapse and extinction. But in the wreckage and ruins, a quieter, more focused, more functional internet was born. Not because of wild ideas or grand visions disconnected from reality, but because a few stubborn builders with real skills refused to quit when everyone else panicked. The internet didn't die in 2000. It rebooted. It learned from failure. It matured. And then it quietly reshaped the entire world in ways far more profound than anyone imagined during the bubble. Have you experienced any modern tech bubbles that remind you of the dot-com crash? Are we in another bubble right now with AI? Drop your thoughts in the comments below, subscribe for more stories about technology's wild history, and let's discuss what lessons we should learn from the internet's near-death experience.